All right, guys, we're back with episode number 2 of the brand new Bitcoin Global podcast. On this show, we talk about the macro situation around the world, including interest rates, trade wars, individual countries, and how they're dealing with this fiat system that is kind of, in our opinion, collapsing. I think that would be correct for Kent as well. So today we are going to talk about yield curve inversion. All right, today we're going to talk about yield curve inversion. Kent, how are you doing? And do you want to take us into the first topic?
Hearty greetings and salutations to your listeners. Well, we got
our listeners.
Sorry, our listeners. Doing a little traveling on this Labor Day weekend. We're going to go out to Central California to visit family. But other than that, just holding steady. Wife got back from Brazil recently, so that's what I got on my end. And how about you? Any plans for the weekend, the 3-day weekend?
Not particularly. So I just moved down to Florida here, and we have a big old hurricane coming. It's supposed to make landfall about Monday or Tuesday, on the East Coast, and that's where I'm living, on the East Coast of Florida. So it's been a little bit different. We have had to go and buy some non-perishable food and get a bunch of bottled water and stuff just in case. I don't think we're going to get hit very hard. It's going to be hitting a different part of the state, but there's a chance for flooding and different things. So
oh wow. Well, I mean, that is goodness. There's what hurricane just down in Miami. Was that just a year ago, something like that, 2 years ago? So
yeah, they had I think Irma was last year, and yeah, a bunch of people I talked to said that one was pretty bad. But again, in our area, not so bad. Where we're living, it's been spared any bad hurricanes, I think, for like 50 years. So
yeah,
that's good.
That sounds about right. So anyway, let's see.
Yeah, jump us into this first.
Cut that out,
I think you have.
Yeah.
No, it's good. I think you have a first couple. Well, you have a bunch of articles that you put together here on a little outline for us. So why don't we jump into the first one here?
Sure. Okay. So today we're going to be discussing the yield curve inversion, but more importantly, the yield curve in general and kind of what it means. I think that when you see periodicals like Bloomberg or the Wall Street Journal, when they write articles about yield curve inversions, they don't really go into details. All they say is, oh, the 2-year Treasury and the 10-year Treasury are inverted, meaning that the interest rate on the 2-year is higher than the 10-year. But they don't really extrapolate. They don't explain what that means or really get into the weeds as to why this is important. They usually do say something along the lines of, this has been an accurate predictor of recessions, going back however far. But basically, to just jump into it, last week, the yield curve inverted twice, or it may have been once last week and maybe it was once the week before. However, the yield curve is currently inverted in the United States. The 10-year Treasury is 1.50%, and the 2-year Treasury is 1.53%. So this has been the case for a couple of days now, and it's really pretty much just staying inverted. I think the most that the 2-year had on the 10-year in the last couple of days was maybe 5 basis points. But nonetheless, it's very flat. Numerous short-term debt securities are inverted in relation to 10-year, and it is getting very interesting out there. We haven't really had an inversion, I don't think, since about 2006. And so,
can you say that last part though that you said that right before that 2006? You said something was corporate debt was inverted, or what was that?
Oh, I don't remember exactly. Was it? I was discussing the. Was it when I was talking about the
something corporate yield?
Don't think I don't think I had anything on.
Anyway, Okay, no, that's okay. Continue. Sorry,
Cool.
dude.
No, actually, I wanted to get your input on the yield curve. Do you follow it closely? Is it not one of the leading things you look at? Do you have any thoughts on it? Curious about your
Well,
thoughts on what's going on.
yeah, I do follow it. I mean, I follow the headlines pretty closely. I am a financial headline follower. Being into Bitcoin majorly, I look at the macro situation and how it's going to affect Bitcoin. Um, and being a Bitcoin trader and investor, I want to know exactly what this macro situation that Bitcoin finds itself in is. The same way with gold. When I was a gold investor, I had the same idea. Even though, gold and Bitcoin, the investment thesis isn't necessarily about the macro situation. The investment thesis is strictly sound money versus fiat money. But if you're going to be a trader and try to pick some entries and exits, you got to look at what's going on. So anyway, yeah, I do follow the daily headlines. I don't think this yield inversion is super strong right now. I don't know how it compares. I think you said 5 basis points was the max so far over the last couple weeks. I don't know how that compares to past inversions. I do expect it to get worse again over the next couple weeks or whatever, maybe spike down to 10 basis points or 20 basis points or something like that. Plus, we're in some weird new normal of negative interest rates. And how does that affect an inversion? I don't know that.
I'll address the first thing you said. I think what typically happens is that all it really has to do is simply invert, even by just a few basis points, because what that does is that creates a situation. Actually, this is probably a good opportunity. I'll quickly explain just a little bit about what a yield curve is, why it's important. Basically, I described the yield curve just a second ago, and that is it's just the difference between the most watched is the relationship between the 2-year Treasury and the 10-year Treasury. And a yield curve inversion is when the yield on the 2-year Treasury, which is in this case 1.53%, is higher than the 10-year Treasury, which in this case is 1.50%. This is significant because banks typically they borrow at the short-term rates and they lend at the long-term rates. So what they need is they need the short-term rates to be significantly lower than the long-term. Otherwise, what happens is the difference between what banks pay to their savers and what they charge their borrowers, that difference is called the float, and that's how they make money. So in essence, they're running into a situation where it's very the way I understand it is they basically are. It's like the gears are grinding to a halt because they can't make money. I don't know. Does that make sense?
Yes, it does. And another way I understand this inversion is a psychological thing as well. So yes, the yield curve dips to inverted pretty quickly, and then it recovers. I mean, if you look at the chart of the history of this, the 2 and 10-year, it usually spikes down and then quickly comes back positive again. And then a few months later, there's a recession or whatever. So it doesn't like stay there for a long period of time. But what I think is almost a more important thing is just this psychological effect of um, people demanding a higher rate in a shorter term versus a longer term. So they are less certain, or they're more uncertain about, say, the next 2 years than they are about the next 10 years. And that is kind of a wisdom of the crowds type moment that, hey, everybody thinks there's a recession coming. That probably means there's a recession coming. Sell everything, and it's kind of a self-fulfilling type of prophecy. What do you think about that idea?
That you offered up a lot of ammo there. The psychological factors is huge because people have access to all these the financial information that's put out even in the mainstream media is very much on board with this idea that probably because they can't ignore it, that yield curve inversions always lead to recessions because they historically always precede them. But there's a very interesting point, and I think you did briefly touch on this as well. And I was reading an article by Lance Roberts from a week or two ago, and what he says is the important thing is not just that the yield curve inverts, it's that the Fed reacts. So the inversion does a couple things. It gets the Fed to react because they need to reestablish that the ability of the float to be positive for the banks. So they go after the Fed funds rates and they try to Fed funds rate and they try to push down that 2-year rate so that there's a positive spread again. But what's also happening is because what you said, you made the point about the psychology of the situation. The yield curve inversion gets people to flee the stock market, and they plunge themselves into those 2-year treasuries. So you have a doubling effect. You have all these people piling into the 2-year, in addition to the pressure, the downward pressure being exerted by the Fed. So it quickly, rapidly re-steepens the curve. But the damage is done because you've basically had a huge capital shift from the stock market into safety, if you will. And that's typically, at least historically, where the problems have arisen. I don't actually have a good timeline for that. Do you know what the timeline is between the inversion and the inversion, the steepening process, and then when the flight from stocks happens?
I've seen, well, I don't know about stocks specifically, but I've seen the chart about the recessions, and that has to be with a GDP rating of negative for 2 quarters. And usually that happens 18 months, within 18 months, usually like between 12 and 18 months of the inversion. Now, stocks, I don't know.
Yeah, Lance Roberts, I was trying to kind of go over a specific point. He's very big on you have to have a yield curve inversion, and then it has to be followed up by central bank policy to push down that short-term yield. And then he explains that at least my understanding is that that people pile into these short-term debt instruments. Now he didn't specify a timeline. This could be a process, if you will. Of people slowly. It's kind of like Raoul Paul says. He always says, pay attention to the bond market because the bond market doesn't lie. And so that kind of tells you what's going on.
Well, the bond market doesn't lie, except that a lot of it's owned by the Fed, right? So yeah, I agree that it's bigger. It's like 5 to 10 times bigger or something than the stock market, but it kind of does lie, doesn't it?
That's a really interesting point because we've always had intervention, but I don't think I know in China, or sorry, not China, excuse me, in Japan, I believe that the Nikkei is like almost owned outright by it's like 60 or 70% of the Nikkei is owned by the central bank, and I know they own tons of debt as well. Yeah, that manipulates bond prices up and yields down. And so the level of manipulation that we have in today's market it's just like this bull run. It's the longest bull market of all time in stocks. But eventually it's going to collapse, but they've really been able to kind of inflate this thing and it seems like every time it's going to take a nosedive, like what was that, 2015, 16, they just find ways to reinflate it, and people are none the wiser. So to your point, that I don't know what that means or how that exactly is going to play out. I think our long run analysis is sound, but as far as the short term, the next couple of years, that's a challenging thing to try and ascertain.
Yeah, well, I think the long term vision is based on debt, like the total amount of U.S. debt, dollar denominated debt. It just is unpayable. So that kind of forms the long-term vision. But the short-term vision, I think, yeah, it's like that saying. Who said that? Was that Keynes that said that markets can stay irrational longer than you can stay solvent? And yeah, it's just juiced up, like you said in the last episode, just government printing or central banks printing money, juicing up stocks. I remember in 1987, I haven't done a ton of research on this, but I did spend quite a bit of time reading about modern history of the Fed. And it was 1987 and then the LTCM crisis that really like set the tone for the central bank saving the stock market. Because just think if they had this policy back in the Great Depression, like we would never have had Black Tuesday or whatever it was. We would never have that because they would have just printed to save the stock market. And this is a very modern thing. It's within the last, what would that be, 30 years, really, that it's become a measuring stick. The stock market is a measuring stick for the Federal Reserve. And one day, like I've said this many times, people probably get tired of me saying this, but one day they're going to have to choose between saving the dollar and saving the stock market. That'll be interesting.
Well, that and we are at the end of it. I mean, I read a Bloomberg article today, and they were talking about how the negative interest rate situation that we talked about in the last episode it's doing significant damage to it's actually retarding the lending process in places like Japan and Europe. And so, lingering around the 0%, which is the end of if you look at the secular bull market in bonds that started with Volcker back in '83, we're at that end, and that seems this somewhere around here seems to be the threshold of what people, markets, et cetera, can take before the thing finally implodes. And so I do want to ask you, because you already brought it up, but how do you think the Fed will respond?
How do I think the Fed will respond? Man, well, when Powell came in, he was a little more hawkish. He was supposed to be hawkish. And then he talked about autopilot with the drawdown, the what do you call it? Quantitative tightening. He talked about that being on autopilot and all this. And then within a month of saying that, they took it off of autopilot and they completely went neutral, right? And then lo and behold, a couple months after that, now they're cutting rates. So I think the trend is going to continue. There is another development with the Fed is that they have no forward guidance anymore. And remember, over the last 10 years, it's been a lot about forward guidance. What are we going to do next? And now people don't know. I mean, on Wall Street, probably Bloomberg or somebody does a poll of the traders and try to see what people think about the next the next meeting. What's the likelihood of a rate cut? And then you have maybe what's the likelihood of a 50 basis point rate cut and yada, yada, yada. Well, that's almost like taking the place of the Fed's forward guidance, these polls that they run with these traders. Plus, then on top of that, you have the freaking president coming in and trying to domineer the Fed. So
100 basis points.
So I don't know exactly what they're going to do here. I mean, if they wanted to be crazy, they would keep it neutral. Imagine that. Imagine them keeping it steady and not dropping it at the next meeting. They'll probably drop it, and it'll probably be 50 basis points, I'm guessing. They might do it in tandem with even some QE or something like that. I know Europe is supposed to be starting QE. China is definitely doing QE. So like there's just a bunch of stuff going on in the world. The Fed kind of has to, or the dollar is going to get very strong relative to the other currencies. What do you think? Well,
the EU actually literally just stopped QE at the same time that the plunge protection team was coming in to rescue the markets. It ended, I think, at the beginning of the year, after that big December crater in the US stock market. And so that means
I think that was the beginning of their taper. I think they're still. I'll Google that.
Yeah,
fast.
Keep fine. I could have sworn that the ECB actually ended their QE style program. If that is the case, then that means that they stopped they stopped QE just 6 months. Well, I guess we're in August, right? So 7-8 months ago, and they're already priming to put it back on the table, which basically means that there's so many zombie sovereigns, zombie companies, probably households as well, and they just cannot function in even a positive interest rate environment, let alone this negative one we're going in. And so
Yeah.
that's I think what do you think are the options on the table? You kind of touched on it already. You always front kind of intuitively know what I'm going to ask, but what do you think's on the table for central banks in terms of their toolbox? What can they do? What can they do? And not only what can they do, but how will it affect the markets in your opinion?
Oh, the markets and what can the U.S. do? I I don't know what they can do because of the debt. The debt is so unpayable. It's laughable how unpayable it is. I mean, it would be laughable if it wasn't so damn destructive and
Do you
scary.
think we go into like a
Um,
hyperinflation, or at least a very, very
Eventually.
significant inflation?
Oh, eventually we will, yeah. And I also tie this back into Bitcoin that Bitcoin is going to continue to grow. I mean, gold. What's the market cap of gold? Like,
8 trillion.
say 8 or 9, yeah, 8 to 9 trillion. And I mean, when Bitcoin gets that big in the next bubble, that's probably coming in the next bubble because that would only be like a 90x increase from here. And Bitcoin does usually like a 50 to 100x on each bull run. So it's going to be in the neighborhood. And when that happens, it might kick off a speculative attack on some currencies. And so maybe the CNY, maybe even the JPY starts, and damn, the euro gets speculatively attacked by Bitcoin, and then that limits even more what they can do. So I don't know. It would be crazy. What they really need is like a Volcker, but they can't do that because of the damn 22 trillion in debt.
Yeah, there's way too much systemic risk to pull a Volcker. Like back then, households and sovereigns were so much more solvent. Debt to GDP ratios were so much lower that well, and I think didn't that eventually cost him his job? I thought he was replaced by Greenspan.
Yeah, he was replaced by Greenspan. I don't remember what the facts around his stepping down was.
Yeah, because he basically allowed. I think he was right before the savings and loans crisis, so he just basically let the zombie companies die, which is that's you have to have a cleansing process. But what I think is going to happen is we have all these feckless politicians, some of which are going to be head of the ECB. Looking at you, Christine Lagarde, and they basically are they don't there's two options on the table for them: raise interest rates and basically collapse the economy that way, or kick the can down the road, make things worse in the long run, and inflate because it is more politically feasible, which is what I think they're going to do. And as a result of that, people are going to be escaping fiat currencies and going into gold and Bitcoin. Gold is not divisible. Gold is not something that a lot of young people know or care about or want to use. It is not digital. And I'm not trying to bag on gold. I'm just saying that Bitcoin has these what attributes that are just. I mean, you can't just say, "Oh, I'm going to put $5 into gold." It does. It's too expensive for a small amount of content. Whereas with Bitcoin, you can just buy some satoshis. You know what I mean? It's just way more divisible in that sense. And so I think Bitcoin's coming out party is it's coming soon, in my opinion.
Yeah, I still think that it's a little bit difficult to buy that small of Bitcoin, but you can definitely on Cash App. I think you can buy as low as 50 cents or something like that. But I don't think you can withdraw that. There's like a minimum withdrawal. Maybe it's $10 or something. Um,
Yeah, because
but
of the fees.
yeah, but there in the future there will be like instead of buying $5 of on chain Bitcoin, you'll get $5 of Lightning Bitcoin, and it'll be a service that you just use. So that's coming. I mean, it's available now, but it's not at all user friendly for people. So I would say that give it another year, maybe 2, and it'll be super, super easy for people to use. And if we don't have that amount of time, I don't know. But I agree, gold doesn't fit this globalized world, this digital world that we have. Bitcoin is digital gold. It's better than gold in many respects. So it's going to end up winning out. Now, I think we might have brought this up on the last episode. Is one thing I'm worried about is the central banks going back to a gold standard. It's very possible that they do that to ward off Bitcoin, and if they do that, Bitcoin's going to take a big hit. I think it'll slow Bitcoin down by a decade or something like that.
I think in the event that they did, that's committing suicide. I think that they're so wedded to their power. In theory,
Yeah.
in theory, if we went back to a gold standard and it derailed Bitcoin, at least we would get a resource-based money to help our economy grow again. So yes, for those of us who put a significant amount into Bitcoin, we'd at least get a healthy economy out of it, which is in some respects kind of the whole point of Bitcoin, was to correct the central banks and governments' poor actions, at least from my vantage.
Yeah, it would be a huge win. It would be a huge win. It wouldn't be a 100% win, but it would be like a 90% win. So that would be good. What about, let's bring us back to the yield curve inversion. How do we want to tie that into? By the way, I did look up the ECB's taper, and yeah, they did. It looks like they ended either January or February by this chart. So yeah, you were right.
Okay, yeah. All
right, let's tie this back in somehow into the yield curve inversion. How do we do that?
Well, I think we worked our way down from the yield curve inversion to the ramifications, and then I think we pretty much did a good job tying Bitcoin into all of it. So it's we kind of walked down the process because
Okay.
we mentioned that central banks are going to have to push down the 2-year, and we kind of worked our way down from there. There's going to it triggers crash and capital flight and all that. So I thought we walked it down pretty well. It's a pretty complicated topic. So
yeah, you're right. I think we did a good job. We are at 27 minutes right now. So
I'm good if you are.
All right, cool, man. That was easy.
Yeah, I thought it was good because I wanted to end on Bitcoin. I kind of want to try to tie that in at the end of these discussions, moving forward, just so people can see how it's all interrelated. Because with the macro stuff, it's everything's
I
related.
agree. And the new meme on Twitter is Bitcoin fixes this. And so every episode we could just end with Bitcoin fixes this, and then talk about how Bitcoin is going to help.